So hello everyone. So I'm going to continue chapter 5. So last class it was about part A, and today we are going to talk about part B. However, I would like to review some important points from part A. And you can see that this is the title of our chapter 5, estimation of unrealized profit. So you should know what is the meaning of unrealized profit related with intercompany sales of inventory. So we have some unrealized profit, and these profits are related with the intercompany sales of inventory. So what is the meaning of intercompany? Intercompany means the sales of inventory within the affiliated group. So consolidated entity, another name of consolidated entity is called the affiliated entity. So another name is affiliated. So if we have any unrealized profit within this affiliated group, how to handle this kind of profit in the consolidated financial statement, we are going to learn. So when you are going to read the question paper, you have to make sure that this kind of sales of inventory is upstream sales or the downstream sales, because some items are common whether it is upstream or downstream, and some transactions are different. So it is important to know which one is upstream and which one is downstream, because the question will not use this word. Okay? The question will not use this kind of terminology, but you have to understand by reading the question whether it is upstream or downstream. So look at this diagram. So here we have parents company, we have subsidiary company 1 and subsidiary company 2. So subsidiary S1 and S2, they are the brother and sister, something like this, and P is the parent. And when the parent company sell inventory to subsidiary, it is called downstream. So the question will tell you that parent company sell inventory to whom? Parent company sell inventory to subsidiary. So at the time you should understand that this is called the downstream sales. We have another option that sometimes subsidiary company sell inventory to parents company. So if this is the case, it is called upstream sales of inventory. And here, if you watch my last class, so we have several things to handle. First one is intercompany sales. So if we have any intercompany sales, we have to eliminate. We have to eliminate our intercompany sales. Okay, and this kind of intercompany sale may be something like this. Maybe P sell inventory to S, or S sell inventory to P. If this is the case, it is called intercompany sales, right? So whether now from here you can easily understand which one is upstream and which one is downstream. So parent sell to S, it is downstream, right? And S sell to P, it is upstream. So both cases, the journal similar. So whenever we do the eliminate journal, okay, then there is no difference. There is no difference whether it is upstream, whether it is downstream. Okay. Now we have another eliminated entry is called intercompany. Look, if you sell your inventory, it related with cost of goods sold, right? Can you remember, you sell your inventory, it is related with cost of goods sold. And if there is difference between sale and cost of goods sold, we have profit, gross profit. So whenever you are selling your inventory, you may have intercompany unrealized profit. Okay, because you sell inventory to subsidiary or subsidiary sell inventory to parents, so there may be have some unrealized profit. If we have any unrealized profit, okay, again we have to eliminate. We have to eliminate the intercompany unrealized profit. Now this kind of intercompany unrealized profit, you have to calculate. That means it is not given in the question. We have to do if any. If any means it may have, it may not have. Okay. It may not have. If we have any, then we have to eliminate them. And you need to do some workings. We need to do some workings to calculate it. So if you want to calculate what is the amount of unrealized profit, we need to do some workings. And if we have any unrealized profit, we have to eliminate them. So whether it is upstream or downstream, okay. So these two journal entries. So we find that we have two journal entries. One for unrealized profit elimination, another is intercompany sales elimination. So these two journal entries are similar, okay, are similar for both situation. Similar for both situation. For example, this is 2000. For example, this is 2019. This is 2019. So in this year, journals are similar. So when we go from 2019 to 2020, when we go from 2019 to 2020, then be careful about upstream or downstream. Do you understand? So from when we go from 2019 to 2020, 2019 to 2020, when we go to the next year, then you have to find out whether it is upstream sales or downstream sales. Okay. And you have to find out whether it is cost method or whether it is equity method. And these two journal entries, whether it is cost or equity, do not have any change. So it doesn't matter. It doesn't matter whether it is cost method or equity method to eliminate intercompany sales and to eliminate unrealized profit. It doesn't matter whether it is cost method or equity method. But whenever we go from 2019 to 2020, another year, okay, or if we come from 2018 to 2019, okay, that means when we shift from one year to another year, okay, when we shift from one year to another year anyway, then we have to find out first. We have to find out whether it is upstream or downstream. Okay, because upstream have one kind of journal entry, downstream have another type of journal entry. And you have to find out whether it is cost method or whether it is equity method, because you know that cost method related with profit. That means cost method, we have something, and for equity method, we have investment account, something like this. So we have different journal entries. Okay. Then here I told you that this is 2019. This is 2019. So 2019 we have unrealized. 2019 we have unrealized profit. Why it is unrealized? Because it is within the affiliated group, right? It is within the affiliated group. But if we have a new transaction like this, so for example, P sell to S and S sell to third party. What is the meaning of third party? What is the meaning of third party? Third party means it is outside the affiliated group. Okay. So when sell made to third party, so S can sell it to the third party or P can sell it to the third party. It doesn't matter who sell it to the third party. Do you understand? Whether it is upstream or downstream does not mean anything. The main mean is if sale is made with third party means outside the affiliated group, then we have to record profit. And this profit is called realized profit. Realized profit. That means earned profit. So if we have any realized profit or earned profit, we have to record this profit. Okay, we have to record this profit in the consolidated financial statement. Do you understand? So if we have any profit realized, then we have to record it to the financial statement, that means consolidated financial statement. But if we have any unrealized profit, within intercompany, then we have to eliminate them. Okay, we have to eliminate them. So whenever you are going to read the question, we have to do some journal entries. So this chapter is quite easy because you only need a little calculation and journal entry. Maybe first journal entry is eliminate intercompany sales. Then eliminate intercompany unrealized profit. So this part you may have chance to do mistake, calculation mistake. So calculation is important here because you should know what is the profit, what is the unrealized profit. So this is not given in the question. Question will not tell you the unrealized profit. You have to calculate it. Okay. And if you have calculation mistake, it means that you are going to do mistake. So these two journal entries, I told you that whether it is upstream or downstream is common, no problem. Now, I told you that when we go from 2000, for example, when we go from 2019 to 2020, then unrealized profit, this unrealized profit, okay, become, that means unrealized profit became realized profit. So when unrealized profit became realized profit, we have journal entry. We have journal entry. And when we have this journal entry, I told you that when we have this journal entry, think about upstream or downstream, then think about cost method or equity method. Okay. Yes, so these are the three main journal entries. You can expect three types of journal entries, right? Three types of journal entry you can expect from your question paper. Now, I am going to tell you first how to eliminate intercompany sales. How to eliminate intercompany sales. This is the first point I am going to review, although I explained it in the last class, but I am going to review this again, how to eliminate intercompany sales. So before eliminating intercompany sales, you should know how to record normal journal entry. So this part I mentioned here, it is not related with your question. This is not the elimination journal entry. Okay, this is not the elimination journal entry. This is the normal journal entry that happened between parents and subsidiary. Because if you don't know this, it is very difficult for you to record closing entries. So first, this example said that parent company sell inventory to subsidiary. Okay, parent company sell inventory to subsidiary, or subsidiary company sell inventory to parent, it doesn't matter. So if parent company sell inventory, then what is their journal? They record sell to whom? Look at it, sell is credit, right? Because they sell it to whom? They sell it to the subsidiary, or subsidiary sell it to the parent. That means it is related with intercompany. Do you understand? They record sales credit $455,000. They record sales credit $455,000, and this is credit. So when they sales, they may receive cash, they may not receive cash. You know that. If they receive cash, they will record cash debit. If they do not receive cash, they will record accounts receivable debit. So if they receive cash, just we write here cash debit. For example, we assume that they receive cash. So they sell, so they record sales credit and they receive cash debit. And you know that in the perpetual inventory system, whenever you record sale of inventory, immediately you have to record cost of goods sold. Can you remember this? So when you record cost of goods sold, we record cost of goods sold debit, and we sell our inventory credit, right? So what does it mean in the left side? Left side means that this cost means parents company buy this first, right? Parents company buy this inventory from third party and sell this inventory to subsidiary. Clear? So this cost is related with outside the company. They buy it from outside and they sell it to the subsidiary. Now, parents company sell is the subsidiary company's purchase, because parents company sell it to the subsidiary. So when subsidiary purchase it, they record cost of goods sold debit. They record cost of goods sold debit. Look at the number. Number is similar. Why number is similar? Because sales price of parents company is the cost price of subsidiary, right? I repeat again, sales price of subsidiary is the cost price of sales price of parents is the cost price of subsidiary. So they record purchase, cost of goods sold debit, and if they pay cash, they will record cash credit. If they do not pay cash, they have to pay cash in future, they will record accounts payable credit. So I assume that it is cash. I can write here cash credit. Now, I told you that here, when parents sell it to the subsidiary, subsidiaries sell it to whom? Subsidiary can sell it to the another party, right? Third party. Now this is the one. Subsidiary sell this inventory to whom? Subsidiary sell this inventory to third party. So they record sales credit. Within bracket, it is not intercompany, right? it is third party. So sales credit, and if they receive cash, cash debit. If they do not receive cash, accounts receivable debit. Again, I assume that it is cash debit. So this is the normal journal entry happened between parent and subsidiary. Okay, so this is the normal journal entry. So it is not the elimination journal entry. But we know that according to the consolidated financial statement, if there is any intercompany transaction, we have to eliminate them. So this journal entry, which one is related with intercompany? Look at it, cash debit, cash credit. It is already zero, right? Cash debit and cash credit already zero. So which other items are related with intercompany? So these items are related with intercompany. Intercompany sales, and this is intercompany cost of goods sold, right? So these two accounts we have to eliminate. These two accounts we have to eliminate. How to eliminate this? If you want to eliminate this one, intercompany sales, before you record credit, now you have to record debit. Look, when you record debit, it is closed. Because before we record, in the normal journal entry, we record is credit, right? Now we record is debit. We record is debit, so it is closed. Clear? Then before we record cost of goods sold debit, now we record cost of goods sold credit. Okay, it is closed. So this is the first journal entry. You have to write it in the exam. This is the first journal entry. That means elimination of intercompany sales. Eliminations of intercompany sales. Okay, to eliminate intercompany sales. Now you can see here, if I ask you, because I told you that if we have any realized profit, where we have to transfer it? We have to transfer it to the consolidated financial statement. So from here, can you calculate? From here, can you calculate which one is the realized profit? So I have two calculations here. One is right, another is wrong. I have two calculations here. One is right, another is wrong. So which one is right and which one is wrong? So how to calculate the profit? Realized profit. Look at here, sales. Sales is common in both situations because this sales is related with third party. So third party. So whenever we have sales with third party, we have to record it as a consolidated sales, right? As a consolidated sales. Now, which one is the cost of goods sold? Which one is the accurate cost of goods sold? 450 or 375? Yes, because this one is related with third party, right? Yes, very good. So this one is related with third party. So it means that the left side is wrong. The left side is wrong. So I delete the left side. So now this profit, $300,000, actually, it is the profit with third party, right? When we have any profit with third party, we have to record it in the consolidated financial statement. So we don't have any journal entry for this. This is for your understanding. This is not related with our question. Clear? This is for your understanding how to record the real profit that we transfer to the consolidated financial statement. So anyway, our first journal is to eliminate. Our first journal is to eliminate the intercompany sales. This is the journal of intercompany sales. We just make it opposite and close it. So in the exam, you no need to show this. In the exam, this is not for the exam. This is for explanation. For exam, okay, this is your first transaction. Now I told you that. So this is the first, eliminate intercompany sales. Then we have to calculate. We have to calculate whether we have any unrealized profit or not within the affiliated group. Within the affiliated group. So if we have any unrealized profit, we have to eliminate. Now, calculation is important. So if you don't know how to calculate, then you have a mistake. So exercise 1, exercise 1 do not have any unrealized profit because why? Because at the end of the year, at the end of the year, there is no ending inventory. So these are the key points. These are key points. You have to read the question carefully. If you find that at the end of the year, there is no ending inventory, what is the meaning? No ending inventory means parents or subsidiary sell everything to the third party. Okay. If you sell everything to the third party, it means that you don't have anything within the company, right? So here you can see that at the end of the year, Sheraton had sold all inventory purchased from the parking to third parties. So everything is sold to the third parties. So the keyword is no ending inventory. Within the affiliated group. Okay, means no unrealized profit. So example 1 said that, and if you want to learn example 1, you have to go back to my previous class. So the summary of exercise 1 is there is no ending inventory. It means that there is no unrealized profit. So we don't have second journal. We don't have second journal. Why we don't have second journal? Because we don't have any unrealized profit, or we don't have any ending inventory. So we don't have any journal. But exercise 2, if you read exercise 2, then we may have unrealized profit. Let me read this question. Exercise 2, it is downstream sales. Okay, so maybe your question don't have this kind of hints. You have to know whether it is upstream or downstream by reading the question. So parents company owns 85% of Sheraton company. That means parking company, and parking company sells merchandise to Sheraton. So parents sell to Sheraton. That means it is downstream, right? Parents in the top position, they sell it to the subsidiary. So it is downstream sales. And when they sell inventory to subsidiary, so when they sell inventory to subsidiary, they add, okay, 20% above their cost. Like here, if you remember here, the journal, first journal. So they sell it, okay. This is their cost price, right? Their cost price is $375,000. But when they sell it to the subsidiary, they add some profit, right? They add some profit. So this is their cost price. They add 20% profit when they sell it to the subsidiary. So this is the question said above. Exercise 2 said that when parking companies sell merchandise to subsidiary, they add 20% of their above the cost, right? They add 20% profit with their cost and they sell it. And they sell how many times? They sell 2 times. 2021, they sell 450. 2022, they sell for $86,000. Okay, so they sell 2 times. And question said that at the end of each year, Sheraton company had its inventory 1/3 of the amount of goods purchased from parking company during the year. That means at the end, Sheraton company is still holding 1/3 of the inventory. What does it mean? That means Sheraton company failed to sell everything. So you are the Sheraton company. I give you, for example, I give you $450,000 of inventory. Okay, I sell it to you. If you cannot sell everything, okay, that means you are holding something. So if you are holding something, it means that there is some intercompany profit. Okay, because look, this 20% is the intercompany profit. Because when I give it to you, I add some profit. And you have not yet sell everything to outside. So how can I say? We are still holding some profit within our company, right? So this profit we have to eliminate. So cost is not given. So if you read this question, sales amount is given. Sales amount is given. So this is the sales amount for 2021. Look at here. This is sales is given. Okay. This is the sales of parents is the cost of subsidiary. But cost of goods sold is not given. So this question, I repeat again, sales given, but cost of not goods sold is not given. We have to calculate the cost of goods sold. And this is the formula. How to calculate the cost of goods sold. The question said that first, the question said that 1/3 of inventory on hand. So I sell to you $450,000, 1/3 not yet sold. So this is not yet sold. Not yet sold means it is ending inventory. This is ending inventory. Ending inventory. And this ending inventory, you know that this ending inventory equal cost plus profit. Right? This inventory includes some cost and profit. And which part is the cost, which part is the profit? We have to apply this kind of formula. We have to apply this kind of formula. Sales, you know that sales equal cost times 1.20, right? One is 100% of the cost, right? Plus we add 20% profit, so 1.20. Now we calculate the cost of goods sold. Cost of. So this kind of calculation you have to do by yourself. Now this part calculate unrealized profit. So this table is going to explain to you to show the unrealized profit. So for example, this number is missing. This number is missing. So parents company sell $450,000. Okay. So this is the first entry we have to eliminate. So this entry we have to eliminate, you know that. This entry we have to eliminate because this is intercompany sales, right? $450,000 is parents company sales price, but this is the $455,000 subsidiary company's cost price, right? So this is the first elimination journal entry. This is the first elimination journal entry. So this is the sales price of parents company. So what is the cost? What is the cost of goods sold? So we apply this formula, cost times 1.20 equals sales. Okay, so this is the cost of goods sold. You calculate, okay, and we find that the gross profit is $75,000. So this is the gross profit of $75,000 from parents. Now, question said that $150,000 is still not yet sell. Is still not yet sell. It means that resold to third party. So if you not yet sell 150, how many you sold to the third party? You sell to the third party is $300,000. Do you understand this? You understand, right? Now this 300, you know that this is the sales price. This 300 include cost plus profit. This ending inventory include cost plus profit. Clear? So we calculate cost. So these two amounts, look at it, these two amounts, I mean these three cost of goods sold. Cost of goods sold we calculate by using this formula. By using this kind of formula, we calculate cost of goods sold for total sales, cost of goods sold to third party, and cost of goods sold to the ending inventory. So here you know that if you sell it include cost plus profit. Cost plus profit. So what is the cost? Cost is 250 and profit is 50. Then we have some ending inventory, not yet sell. So this ending inventory also include cost plus profit. Okay, this ending inventory also includes some cost plus profit. Clear? So we know what amount is the cost. 125,000 is the cost, and the profit is $25,000. So this is our second journal. This is our second journal. We have to eliminate. We have to eliminate this $25,000 because this $25,000 is called intercompany profit, right? And it is unrealized. Why it is unrealized? Because it is not yet sold. So this $50,000, this $50,000 is called realized profit. Realized profit. Why it is realized profit? Because it is already sold to whom? It is already sold to third party. But subsidiary holding $150,000 inventory. Okay, subsidiary holding $150,000 inventory, it includes some profit. And this profit is related with intercompany profit. And why it is called unrealized? It is called unrealized. It is called unrealized because it is not yet sold. Right? Now we have to eliminate this $25,000. Now the question is how to do this elimination. If you remember my first class, I told you that if you record cost of goods sold debit, okay, if you record cost of goods sold debit, it means that your profit will increase or decrease. You record cost of goods sold debit. Cost of goods sold increase means profit decrease, right? So if we want to eliminate this, then your cost of goods sold should be debit, right? And this cost of goods sold is related with which account? This cost of goods sold is related with your ending inventory, right? So look at the journal. Look at the second journal. So this is the second journal. We record cost of goods sold ending inventory debit because this cost of goods sold is related with our ending inventory. So we record cost of goods sold. We record cost of goods sold ending inventory debit. It means that this $25,000 closed. This is intercompany unrealized profit, right? It is closed. And we record inventory credit. Why we record inventory credit? Because inventory is cost plus profit. That means inventory $25,000 is overvalued. We should record inventory at cost price, right? Because we are holding this inventory. We should record this inventory at cost price, but we find that it is already included some profit. So it means that inventory is overvalued. Now we have to record inventory credit. It means that inventory become to the cost. Okay, so that's why the second journal we record cost of goods sold debit and ending inventory credit. So this is the second journal. So this is the second journal. Second journal is eliminate unrealized profit. Unrealized profit. And it is called intercompany actually. Intercompany profit. And if you remember, I told you that at this moment, this is, for example, this is 2000. Let me see the question. This is 2021. Okay. So this is 2021. This is 2021. And in this year, $50,000 is realized, right? So total profit is $75,000. But how many we earned? We earned already $50,000, right? And we not yet earned $25,000 because we are holding this. When we are holding this, it is 2021. So when 2021, then we go to 2022. What will happen? So this ending inventory you are going to sell. This ending inventory you are going to sell in the next year. Do you understand? At this moment, you are holding $150,000, right? This is 2021. Look at here. This is 2021. You are holding 2021. You are holding this. But when 2022 came, you have to sell it first, right? So this $25,000, if you sell it, look at here. If you sell it, it become realized. Try to understand. This is the next year. This is the next year. So at this moment, this is 2021. It is unrealized, but when 2022 came, you sell it, right? You sell it and it is going to add with whom? It is going to add with your realized profit. Why it is become realized? Because you are going to sell it. Although 2021 not yet sell, but when next year came, look at here. When next year came, next year means 2022. When next year came, then it became a realized profit. Do you understand my point? At this moment you are holding, right? So you record it unrealized and you close it. But next year, you know that beginning inventory, you have to sell it first. So when next year came, you sell it. When you sell it, then this profit become as realized profit. So that's why I use plus sign here. So when we have realized profit, okay, then what should we do? We have to, because before we close it, right? Before we close it, now when it is earned, we have to return back everything. We have to return back everything. Now, how to make it plus? Before, when we make it minus, look at here. When we make it minus, 2021, we minus it. That means we close it, right? And I told you that if cost of goods sold debit, it means that profit is going to close, right? Now, if you want to add it back, how do you have to do? You have to record cost of goods sold credit, right? Cost of goods sold credit means profit is increasing. And this cost of goods sold, before we record cost of goods sold ending inventory, right? Now it is another year. Another year we have to record cost of goods sold beginning inventory, because ending inventory goes to the beginning inventory of the next year. So this is the third journal. This is the third journal. And in the third journal, you can see that I record cost of goods sold beginning inventory credit. What is the meaning? Before we record, look at it, before we record cost of goods sold debit, it means that profit close. Now we sell it and we record cost of goods sold beginning inventory credit. It means that this money is added back. Okay, this money is added back. Now we transfer this money to our retained earnings. This profit, you know that we profit transfer to our retained earnings, right? So here beginning inventory means this money is ultimately goes to our ending inventory later on. Okay, so we are going to close, we are going to decrease our beginning inventory. We are going to decrease our beginning inventory. It means that this money ultimately will add to our ending inventory, ending retained earnings. So beginning inventory debit. Why beginning inventory debit? I told you that whenever we have any realized profit, we have to think whether it is cost method or whether it is equity method, right? Whether it is cost method, whether it is equity method. So we don't have, this is downstream sales anyway. So if it is cost method, we record beginning retained earnings debit. If it is equity method, we record investment debit. This is the difference of the cost method and equity method. So first we record cost of goods sold credit. Cost of goods sold credit means this $25,000. This $25,000 is added back, right? And added back means this money is going to, if it is equity method, this money is going to add with your investment account, right? And if it is cost method, this money is going to add with your profit, then profit goes to retained earnings. So this is about this is about the last class now. And this first part of the question, it was downstream sales. Now today's class is about upstream sales. If we have upstream sales, then we have to do something more. Now read this question. Read this question carefully. So parents company owns 90%. Parents company owns 90% of the common stock of subsidiary company. The stock was purchased for $810,000 on January 1st, 2019. Okay, so up from first part only important if it is upstream sales. Okay, if it is upstream sales, you have to think about the percentage of the parent, because upstream sales means subsidiary sales to parents, right? Subsidiary sales to parents. So if this is the case, you have to think from the very beginning, you have to think that 90% related with parents and 10% related with NCI. So if it is upstream sales, I repeat again, if it is upstream sales, that means you have to consider NCI. Okay. So here only this part is important. Exercise 3. Read the second part of the question. Second part of the question said that January 1st, 2019, okay, inventory of parents company include $45,000 profit recorded by Seagull company on 2018 sales. This is very, very important point, and you may have chance to do mistake. Look at here. Look at the year. 2019 inventory includes. 2019 inventory includes. So whatever I first try to understand that whatever 2018 ending inventory, 2018 ending inventory is the 2019 beginning inventory, right? So $45,000 of inventory is included where? Is included in 2019, and it came from 2018. So what is the meaning? The meaning is here. The meaning is here. This is 2021 ending inventory. This is 2021 ending inventory, right? And unrealized profit was $25,000. Unrealized profit was $25,000. So this one, next year we add it, right? Next year we add it. So this is the information given in the question. Question said that previous year, okay, unrealized profit $45,000 that was related with inventory. Okay, it transferred to where? It transferred to the beginning inventory of 2021, like here. So this I repeat again, on January 1st, inventory of parents company include $45,000 profit. Do you understand what is the meaning of profit? It is unrealized profits. Before it was unrealized profit. 2018, we already eliminate in 2018. So this unrealized profit already eliminated in 2018. Now 2019 came, it became profit. Do you understand? It became profit. So this $45,000, it was unrealized profit last year and became realized profit as 2019. So this journal is related with here. So this is the journal. Do you understand? This is the journal, because this is the next year. This is the next year. So we have to do this journal entry. We have to do this journal entry for this part. Do you understand? This is the critical part of this question. The question said that you have some realized profit that came from previous year. So you have to record it. Now what happened this year? During 2019. So this is for only 2019. During 2019, subsidiary sale to whom? Subsidiary sale to parents. That means it is upstream. So what is the sales amount? $300,000 is the sales. So this is actually, this is our first journal entry in this question. For this question, this is our first journal entry. Why? Because we have to eliminate this, right? We have to eliminate our intercompany sales. Then when companies sell it, when subsidiary companies sell to the parent, how they determine the selling price? They said that it is with a markup of 20% selling price. That means based on this information, you have to calculate cost of goods sold. So you have to calculate cost of goods sold based on this markup information. Because in this question only give you sales amount, right? And when you sell it, you are the subsidiary. When you sell it to me, for example, I am the parent. When you sell it to me, you include 20% markup. That means question do not give you cost of goods sold, you have to calculate. Again, ending inventory of parents corporation includes goods purchased 2019 of single company $75,000. So this is ending inventory and this is our second journal. Why this is our second journal? Because this is the ending inventory, right? And this ending inventory include cost plus profit. Cost plus profit. That means we have some unrealized profit. We have unrealized profit. According to this question, okay? According to this question, this is our second journal. So we have to eliminate intercompany sales. We have to eliminate unrealized profit that you need to calculate first, right? You need to calculate first. Then this is the third journal. This is the third journal. Third journal said that we have some unrealized profit in the year 2018, but it now transferred to 2019. So this is the third journal. And if I change this question, I can add fourth journal. Okay, so I can make it easy for you. So first, we are going to calculate unrealized profit. We are going to calculate unrealized profit. This is the first part of the question, for example. Then second, that means journal entry. I make it short. Record intercompany. Record intercompany sales. Then record of intercompany unrealized profit. Okay. Then record, according to this question, record the earned profit, okay, realized profit earned during 2019. It means that this is came from 2018. So this is up to here actually our question. Up to here, this is our question, but I can add another journal, okay? I can add another journal, record realized profit earned 2020 came from 2019. Do you understand? Yes, so I'm going to show you everything now. So this is our first journal entries. These are first journal entries, that means this one, okay? This is the first journal entry. Second journal entry is eliminate unrealized profit. So this is the second journal entry, eliminate unrealized profit. And to do successfully second one, we need to do some calculation. So this is workings. So you have to do this kind of working successfully. Okay, you have to do this kind of working successfully to answer part 2, right? Then we are going to record realized profit, the second part of the question, this one, third journal entry. Third journal entry is this one. This is the third journal entry. Now I can add fourth journal entry. That means what is realized, sorry, what is unrealized in 2019, right? What is unrealized, this one. What is unrealized in 2019 can be realized in 2020, right? Can be realized in 2020. So you can expect this kind of things in your exam also. Whether it is upstream sales or downstream sales doesn't matter. Okay, so you can think about this. Now the question said that when subsidiary or parents, anyone, no problem, sell it to the intercompany at 20% markup. And this is the formula for markup. This is the formula for markup, means sales equal cost plus profit, right? Sales equal cost plus profit. So here profit means 20% markup. 20% markup is cost plus profit. Profit is 20% of the sales. And if you do this, I show you only one calculation. I show you only this one. I show you only this one. But for these two, the same formula. These two for the same formula. I can show you the next two. This is the first one, okay? This is the first one. For the second one, just change here. This is 2 to 5. Just change here 2 to 5. 2 to 5. 2 to 5. Okay. Anyway, and it is 180. 80. You can do the same. Another part, it is $75,000. So 75. $75. Okay, 75, and it is 60,000. So this kind of simple calculation you should do. So look at here, I calculate 60,000 cost of goods sold. Okay, this is 60,000. I calculate 180,000 cost of goods sold, 180, and I calculate 240,000 cost of goods sold, 240,000 cost of goods sold, because this is the sales amount. Okay, this is the sales amount. So this is the intercompany sale. This is our first journal entry. Okay, and still this is the ending inventory, right? If it is the ending inventory, that means the remaining resold. You understand? And everything include cost plus profit. So the first row include cost plus profit, right? So we now separately record cost, and sales minus cost of goods sold equal gross profit. So sales minus less cost of goods sold. Sales less cost of goods sold equal gross profit. Equal gross profit. So this is our first journal entry to eliminate, and this is our second journal entry to eliminate. This is our second journal entry to eliminate. Okay. To eliminate. Okay. And these two journal entry don't have any upstream or downstream. Whether it is upstream or downstream, same journal. Look at here. Upstream or down, all method. Whether it is cost method or equity method, upstream or downstream, same journal entry. And I already explained, right? I already explained this, how to close this. Now, question said that to recognize intercompany profit, okay? Intercompany profit in the beginning inventory. Beginning inventory means this one, our third one. So we record realized profit that earned during 2019, and it came from 2018. It came from 2018, right? So this one we are going to allocate. So how much profit we are going to earn here? Try to understand. See here, we earned $45,000 of profit, right? So this is $45,000 profit we earned in the year 2019, and it came from where? It came from last year. And this one, this 45,000 already closed last year. But this year we have to earn it. Now, you should know that this $45,000, it is upstream, right? That means this $45,000 gross profit holding by whom? Subsidiary. So subsidiaries sell to the parent and have $45,000 profit. So if you remember our chapter 3 and 4, if subsidiary have any net income or profit, some part goes to the parents, some parts go to the NCI. Can you remember? So this $45,000 profit is not 100% of parent, because our portion said that 95% parents and 10% NCI. So this profit 90% P and 10% NCI. 10% NCI. Okay. Now look at the journal entry. Look at the journal entry number 3. So profit is added back. This $45,000 we eliminate 2018, but when 2019 came, we added back. Added back means now cost of goods sold credit. Cost of goods sold, why it is beginning inventory? Because 2019 18 inventory is the 2018 ending is the 2019 beginning. So we record cost of goods sold credit. It means that this money is added back. This money is added back, right? And this added back money goes some part the parents company. Parents will receive 90%. Parents will receive 90%, and subsidiary will receive 10%. Subsidiary will receive 10%. If it is cost method, I told you that if it is cost method, we transfer this money to the beginning retained earnings. If it is equity method, we don't have any retained earnings, we have investment, right? This is the only difference. This is the only difference. So this is 90% parents and 10% NCI. So this is the equity method. Read the question carefully, whether I mention equity method, whether I can mention cost method. Okay, so it is upstream sales, right? Upstream sales. So we have NCI. We have NCI, and we have to look for, because first two, no method, everything, every situation similar. Now this question, if I add this part in the question, that means part 2 already record eliminate. So this $15,000, okay, the $15,000 already eliminated. Already eliminated. Why it is eliminated? Because it is unrealized. It is unrealized. Now, if I add this question, what is the journal entry for this amount, realized part, that came from 2019? Okay, that came from 2019. We have another journal entry, and this journal entry is related with here, like this. Like this. And if we have, if it is upstream, that means that we already have the journal entry. I can show you here. So this is the same things we are going to do here. The same things we are going to do here. It is for 15,000. It is for 15,000. Okay. It's 15,000, right? Yes, so 13,500, right? 15%, yes. And this is the case. This is the case. So this is 4. I mean, when it is 4, if the question tell you that whatever you close it in 2019, okay, we earned it 2020 anyway. So this is the journal. Teja journal. Okay. Now read exercise 4. Exercise 4 said that every information came from exercise 3. Okay. Every information came from exercise 3, but assume that they are not upstream, they are downstream. What is the meaning of downstream? Downstream means parent sell to subsidiary. If parent sell to subsidiary, then there is no NCI. Okay, there is no NCI. So look the same journal. First two is the same journal, right? First two is the same journal. For the another one, when you allocate the profit, when you allocate the profit, there is no NCI. Do you understand? But if it is upstream, look at here. If it is upstream, we have NCI. We have NCI because upstream means profit transfer from subsidiary to parent, but parent cannot take 100%. Okay, parent cannot take 100%. Parent should record something for NCI. So exercise 4 is the same question. Same question. I just change here from upstream to downstream. I repeat again. Downstream means parents sending profit to subsidiary, right? So parents is not going to share their profit with anyone. But if subsidiary send profit to parents, parents say that, oh, I am only holding 90%. I will record 90%, remaining NCI. So